Most people assume wealth is built by chasing the newest trend. Today, it's artificial intelligence. Yesterday, it was cryptocurrencies. Before that, it was internet stocks. And throughout history, every generation has believed that this time is different. But what if I told you that across 5,000 years of human civilization, only a handful of assets have repeatedly survived wars, empires, currency collapses, technological revolutions, and financial crises? Even more remarkable, 3 of those assets have never gone to zero. And one of them just made a major move that investors around the world are paying very close attention to. Here's what's really happening behind the headlines. Gold has surged once again as markets react to shifting geopolitical tensions, changing interest rate expectations, and an increasingly fragile global financial system. Recent developments involving the United States and Iran, along with a weakening dollar and declining bond yields, have pushed investors back toward precious metals. Reuters 1. But this story is much bigger than one week's price movement. Most investors are looking in the wrong place. They are staring at daily price charts while missing the deeper forces reshaping the global economy. Inflation remains stubborn. Government debt continues to rise. Supply chains are becoming geopolitical weapons. Energy security has become national security. And central banks are quietly preparing for a world that may look very different over the next decade. Today, we're going to connect those dots. We'll explore 6 important ideas. First, what's really happening behind gold's latest move. Second, the hidden supply constraints that very few people discuss. Third, why demand for hard assets continues to evolve. Fourth, what history teaches us about periods like this. Fifth, why governments and institutions are paying close attention. And finally, what all of this could mean for ordinary people trying to protect their purchasing power. Because this isn't simply a story about gold, it's a story about trust. Trust in currencies, trust in governments, and trust in the systems we depend on every day. Let's begin. Gold's latest move is not simply a reaction to one geopolitical headline. Here's what most people don't realize. Gold is a thermometer for uncertainty. When uncertainty rises, gold often attracts attention. When confidence rises, gold may pause. But underneath those short-term movements, much larger trends are unfolding. Think of the global economy like a giant machine. That machine runs on 4 things: energy, debt, confidence, and trust. If one component weakens, the entire machine becomes unstable. Today, several of those components are under pressure simultaneously. Global debt has surpassed levels that would have been unimaginable 20 years ago. Many governments are running persistent deficits, and central banks continue searching for ways to diversify reserves. Meanwhile, Singapore has announced plans to build a major gold clearing system and expand vaulting services for central banks, reinforcing gold's growing strategic importance in the global financial system. Reuters 2. This isn't a conspiracy. It's preparation. If you're interested in understanding the forces shaping precious metals and the global economy, consider subscribing. I post videos like this regularly. Now let's talk about supply, because supply is where the story becomes extremely interesting. Most people assume we can simply produce more gold whenever demand rises. Reality is far more complicated. Imagine trying to fill a swimming pool while someone keeps turning off the hose. That's essentially what's happening. Mining is becoming more difficult. Ore grades are declining, energy costs remain elevated, permitting timelines are stretching longer, and geopolitical risks are increasing. Countries like Mexico, Peru, China, Russia, Chile, and Australia collectively account for a substantial portion of global mining production. Any disruption in those regions can ripple across international markets. Mining projects are not built overnight. From discovery to production can take 10 to 15 years. That means decisions being made today may impact supply for an entire generation. Meanwhile, energy prices remain a major variable. Mining is an energy-intensive business. Every truck, every machine, every processing facility depends on affordable energy. When energy becomes expensive, mining becomes expensive. When mining becomes expensive, supply becomes constrained. This creates a slow-moving but powerful dynamic. Unlike technology companies, miners cannot simply scale production with a software update. Physical constraints still matter, geology still matters, time still matters, and that's something modern markets often forget. Now let's turn to demand. Because demand for hard assets is evolving in fascinating ways. Gold occupies a unique position. It is both ancient and modern. Unlike silver, which has heavy industrial applications, gold's primary role remains monetary and strategic. But demand is changing. Central banks continue accumulating reserves. Institutional investors are reevaluating portfolio risk. Family offices are increasing diversification. And geopolitical uncertainty is driving interest in assets outside traditional financial systems. According to the World Gold Council, central bank purchases remained elevated in early 2026, with reported buying reaching 244 tons in the first quarter, while China extended its buying streak and Poland remained one of the largest purchasers. World Gold Council 3. Why does this matter? Because central banks are not short-term traders. They think in decades. When institutions with multi-decade time horizons continue accumulating an asset, investors should at least ask why. At the same time, AI infrastructure, electrification, defense spending, and energy transitions are increasing competition for strategic resources across the board. The world is becoming more resource-intensive, not less. And if this analysis is helping you connect the dots, subscribe and join our growing community here at Precious Metals Alert. History offers another important lesson. History rarely repeats perfectly, but it often rhymes. Let's go back to the 1970s. Inflation surged, energy prices exploded, confidence in monetary systems weakened. Gold performed exceptionally well during that decade. Then came 2008. The global financial system nearly collapsed under excessive leverage. Once again, investors sought safety. Then COVID arrived. Supply chains fractured overnight. Shipping routes became bottlenecks. Entire industries realized how dependent they had become on global efficiency. Today, we're witnessing a blend of all three environments: inflation risks, debt risks, supply chain risks, energy risks, and geopolitical fragmentation. No, this doesn't mean catastrophe is inevitable, but it does mean resilience is becoming valuable again. The world is moving from a period of maximum efficiency toward a period of maximum security. Countries are reshoring industries, diversifying supply chains, and stockpiling strategic assets. These shifts happen slowly, then suddenly. That's how history often unfolds. Now let's discuss why smart money is paying attention. The phrase smart money doesn't mean someone knows the future. It simply refers to institutions with long time horizons and enormous amounts of capital. Central banks, sovereign wealth funds, family offices, large institutions. These organizations understand a simple reality. Debt levels matter. Global debt continues rising faster than economic output in many parts of the world. Governments face difficult choices: raise taxes, reduce spending, or create more debt. None of those choices are politically easy. As a result, concerns about currency debasement continue to linger. This is one reason many emerging economies have increased their gold allocations over recent years. The World Gold Council reports that central bank demand remained resilient through 2025 and continued into 2026 despite record prices. World Gold Council 4. Meanwhile, BRICS nations continue exploring alternative settlement systems and reducing dependence on any single reserve currency. Again, this doesn't mean the dollar is disappearing tomorrow, but it does suggest diversification is accelerating. If you're finding value in these deeper macro insights, consider subscribing because we cover the stories mainstream media often overlooks. So, what does all of this mean for ordinary people? This is perhaps the most important question, because macroeconomics can feel distant, but its effects are incredibly personal. Inflation affects groceries, interest rates affect mortgages, currency purchasing power affects retirement. No one can predict the future with certainty, but understanding the forces at work allows people to prepare rather than react. The goal is not fear, the goal is resilience. Historically, three categories of assets have repeatedly survived thousands of years of economic change: productive land, precious metals, and human productivity itself. Land produces food, precious metals preserve purchasing power, and human skills create value. None have been perfect, but all have demonstrated extraordinary durability. The lesson is diversification. Don't depend entirely on one asset. Think long-term, manage risk, stay patient, and remember that preserving wealth is often more important than chasing maximum returns. Because losing purchasing power slowly over decades can be just as damaging as a market crash. As we conclude, remember this: markets move in cycles. Headlines come and go, but the laws of supply and demand never disappear. Today's gold move is not just about price, it's about trust. It's about debt, it's about geopolitics, it's about how nations prepare for an uncertain future. We discussed how supply constraints are becoming more important, how demand continues evolving, how history offers valuable lessons, how institutions are adapting, and why ordinary people should pay attention. None of this guarantees a specific outcome. There are no certainties in investing, only probabilities. But probabilities matter, especially when the same themes keep appearing across multiple sectors simultaneously. Pay attention to the trends most people ignore, because sometimes the biggest opportunities emerge long before the crowd notices. And perhaps the most important takeaway is this: the world is changing faster than many people realize. The financial system is adapting. Governments are adapting. Central banks are adapting. The question is whether investors are adapting too. If you found this analysis valuable, please like the video, subscribe to Precious Metals Alert, and share it with someone who wants to understand the changing world around us. Until next time, stay informed, stay prepared, and keep your eyes on the metals. 1. https://www.reuters.com/world/India/gold-gains-over-1-after-us/USD-Iran-reach-P-deal-20266-06-155/?mark UTM_source Gold drifts higher as Iran, US agree to halt war. 2. https://www.reuters.com/gold-2026-06-155/chatGPT.com Singapore to establish OTC gold clearing system, introduce central bank gold vaulting services. 3. https://www.gold.org/gold-demand-trends/gold-demand-trends-Q1-2026/central-banks/question-mark UTM_source=chat-GPT.com Central banks jock World Gold Council. 4. https://www.gold.org/gold-hub/research/gold-demand-trends/gold-demand-trends-full-year-2025/central-banks question-mark UTM_source=chat-GPT.com Central banks or World Gold Council.